Well, good afternoon, and welcome to today's Lord Mayor's Lecture, part of the Knowledge Miles series, sponsored by the Worshipful Company of International Bankers today. I'm delighted that we have with us Mark Berman, CEO of CompliGlobe, to talk about the city, Wall Street, two markets divided by the same language. My name is Mike Wardle. I'm the Chief Executive at ZN, and I'm a convener for this session this afternoon and will be moderating for the lecture. We've got a very simple format. My introduction says will take 5 minutes, more like one and a half, which will leave us plenty of time to hear Mark's keynote presentation, and then we'll have at least quarter of an hour, 20 minutes for Q&A. If you haven't used the GoToWebinar system before, the way in which to ask a question is to find the question tab on the dashboard on your screen. You can type in your question or your observation, and that will come to us to field during the Q&A. You can put in a question at any point during the presentation, so if a thought strikes you, please do type it in so we don't lose it. The session is being recorded today, so that if you want to go back and re-listen, re-watch the recording, you will be able to do so, or particularly if you think it would be interesting for one of your colleagues or friends to see the opportunity will be there to share the link, and that link will be up on our website within the next 24 hours or so. So I think that's all I need to do by way of housekeeping. Just to introduce Mark Berman. Mark's very well known, I think, in financial services regulation, compliance and law. He's worked with the Securities and Exchange Commission, the London Stock Exchange at Merrill Lynch, and is really well known for his expertise in financial services regulation, SEC practice and compliance matters. He's going to be talking today about some historical issues around regulation, but I should just want to mention that alongside his practice in financial regulation, he's well up on softball and baseball, and has been recognized internationally for his work in promoting sport development. So, Mark, really looking forward to your presentation today. The floor is yours, and over to you.
Thank you, Mike. Hello, everyone, and good afternoon. It's good to hear everybody. I won't be able to see you, but what I'd like to do is to walk you through what we call the developments, the major events, and really what we call the backbone of financial services regulation, both here in the city and on Wall Street. And as we go through, we'll talk about some key issues, some common things. We'll talk about how regulation developed, why regulation developed, some of the more interesting things, some of the more infamous developments. And we'd like to give you really a view of what is really shaping financial services regulation to take you all the way through the history, but also a development that just occurred a few hours ago where the government has proposed a new bill to treat Bitcoin and certain currencies as personal property. So where do we begin? Well, a lot of people think we can go back to ancient times, to Roman times, where there were companies formed that were designed to raise money for people that were the equivalent of shareholders. We have some anecdotal evidence that that's true. We also have some various tales. But our story today begins here in London in 1285 with the statute of Edward I, where he attempted to regulate brokers working as agents to take an oath of good behavior. So that's really one of the few formal milestones that we have where it became necessary to attempt to impose controls on people that were involved in what we're loosely calling the investment and the money management and the banking and the brokerage business. It was important because while money was being moved, abuses were occurring, and it was felt important to be able to impose restrictions on people engaged in those activities. Now, as we go through the years, we start to develop into the 1500s, where we had the Antwerp Bourse, the world's oldest formal exchange. In 1571 here, we opened up the Royal Exchange. The Amsterdam market was created in 1611, where the Dutch East India Company conducted the first IPO that we know of. And of course, we know that that led to the Dutch tulip bulb bubble, 1636 and 1637. So events developed to the point where it was necessary here in England to take additional steps to regulate financial services. 1696, which was the Act to Restrain the Number and Ill Practice of Brokers and Jobbers. And what this did was it brought in a number of different requirements. It put a cap on the number of licenses that brokers could have, 100. It banned self-dealing. In other words, you couldn't deal for your own account with a client, and you had to keep books and records. And this was more of what we call a formal introduction into what we call the application of financial services regulation into people engaged in the industry. We fast forward again, we come up to the 1700s, where we have the South Sea Company being formed and the South Sea Bubble, where many people put in money and lost it very, very quickly. Of course, we had various stock jobbing acts all the way from 1721 to 1737. But at a certain point, we began to go away from what we call the role of an exchange and the role of brokers to try to come in and deal and regulate for the first time the entities that were raising money. We had a Board of Trade report in 1844 that led to the Joint Stock Companies Act in 1844, and the first of what we call a prospectus, a circular, a handbill, or a public notice, which had to be submitted to the registrar of the joint stock companies. Now, this is the first time we're starting to get provisions for shareholder information, inspection of company books and records, prescriptions and directors borrowing without shareholder approval, disclosure of director contracts. In other words, under this, you could not sell securities without a certificate of registration. Does this sound familiar? Well, we'll start to see how all of this is developed into the current law we have here in the United Kingdom, and also what we have in the United States and in many other countries. We continue forward with the Companies Act of 1864, the development of prospectus disclosure requirements, the 1890 Directors Liability Act, and the Companies Acts 1900 and 1907, providing for something that we call full disclosure. In other words, you could file a prospectus, you could sell securities, but you have to make full disclosure. So the concept of full disclosure is very important, as we'll see when we start to take a look at events that took place on both sides of the Atlantic during the crash in the Great Depression, 1929. So we fast forward now and we start to take a look at what we call the primary mechanism in this country where securities could be bought or sold, the London Stock Exchange. Now, the exchange dates from the 16th century, where we had the Royal Exchange and the existence of stockbrokers. We come forward to the first organized market in March 1801, when the stock exchange itself formally came into existence. And there were various other exchanges going on around Europe, Paris, Amsterdam, various other places. But this is the one that was really on its own starting to emerge. In the 1800s, we began the development of putting in place rules of the exchange, regulation, operating mechanisms, raising money to fund the national debt, raising money for railroad development. There were many things. And it became internationalized in the years leading up to World War I. What were the influences on it? Transferable securities becoming commonplace, the telegraph, telephone, increased capacity, starting to do things in a more meaningful way, which meant as things were going and getting bigger, of course, it was very important to have regulation. We then pick everything up after the end of World War I, going through the beginnings of the 1920s and the Depression, where we were becoming a little more formalistic in rules. We did have the Great Depression. We had World War II, the rebuilding. And then in the 1950s, we start to see the stock exchange going through a period of decline, where it had to raise money. Relations were not exactly good with the government. In other words, if you think about the stock exchange at that time, it was really the premier and preeminent entity. Um, Policing of members became important, and we started to see the nascent provincial exchanges coming up and the beginnings of integration with US firms going into the exchange. In the 1970s, we started seeing the stock exchange going through what we call a period of threat. The ability of members to block proposals, investigations by the Monopolies Commission, um, early stages of technology and competition, computerized trading, and of course, that takes us into the events in the 1980s. We had, for example, the restrictive practices court hearings taking place in July 1983, the 1986 abolition of fixed commission rates, Big Bang as we know it, the separation of jobbing and broking, moving to screen-based trading, the Gower report, and effectively what we're doing then is we're turning around and saying where in the United States we've already had a good 50 years of financial services regulation. We are now going to formalize things and put things in place here in the Financial Services Act 1986. So then we see the stock exchange going through a loss of its position with monopoly, didn't merge with Life, expansion of tradings on SEAC, various other things. Now, oddly enough, when I was at the stock exchange in the legal department, one of the tasks that I was given in the early 1990s was to take all the rules, developments, pronouncements, and turn it into a unified rule book, 1983, 1984. And it was interesting to go back and take a look at the various pronouncements that we were given to try to take a look at and try to deal with. It was a lot of work, but we managed to come out with a unified rule book. What was significant about that exercise was that in many ways, the reformulation of the rule book and the markets themselves began to put in place a diminishment of the role of the big city firms to be able to dictate to the stock exchange what it could do, getting rid of the justification rules and various other things. Um, During this period of time, the late 1980s, we began to go through a period cross-border of having significant cross-border global privatizations. BP, BT, various others, Hong Kong Telecommunications, many big offerings. And there were situations where United Kingdom requirements didn't quite match with United States requirements. So one of the projects that I worked on was the passive market making, where in the big global privatizations, under rules that the SEC had enforced, firms that were selling securities and affiliates had to get out of the market during the distribution. And that meant that their affiliates on the stock exchange had to be out of the market for 30 days. The mismatch, 30 days in the exchange, 3, 5, 7, and 10 days in the US created a mismatch. So the stock exchange went to the SEC and got relief to develop passive market making. Things like that are extremely significant because what it's showing is where the two markets were dissimilar in policy and structure, it began to show an era of enhanced cooperation between the United Kingdom and the United States regulatory authorities, something that I worked on when I was at the SEC, both in the Division of Corporation Finance and the Division of Market Regulation. So as we go forward, we start to see issues develop, not just in cross-border regulation, but in regulation in each side, in each country in different ways. I want to hit a couple key issues in regulation because we're going to see how these develop and come forward. Fiduciary duty. Now, fiduciary duty is extremely important, and it's based on English common law, several hundred years of it, and what we call the concept of trust. So really what it's saying is that we have to mitigate the harshness of law, and we have to be ethical, we have to deal with fiduciary duties, and we have to find a way to bring equity itself into law. So it really put in place the concept of acting as a fiduciary and putting in the duties of loyalty and the duties of care, full and fair disclosure, telling all the material facts, acting in the best interests of clients, the duty of best execution, suitability, and a reasonable basis for recommendations. Now, those are enshrined in English law. They came across to the United States and were really brought to the fore in two extremely important court cases. Minor v. Salmon, New York State Supreme Court case, opinion written by Mr. Justice Cardozo, and a U.S. Supreme Court case, 1963, Capital Gains Bureau, which is what the SEC uses under Section 206 of the Advisors Act, the anti-fraud provision that allows them to impose fiduciary duties on advisor and to take enforcement action when advisors breach those fiduciary duties. And let's talk about some other issues that are key in regulation: protecting assets against theft, making sure that information is provided, what we call full and fair disclosure, preventing the misuse of inside information. Oddly enough, for many years, it wasn't illegal to misuse inside information. It really came out in the United States and was exported around the world. And now, as you know, it is civil or criminal offense to misuse inside information to trade or to tip. Um, there were issues about the ease of fraud, manipulation, deceit, conflicts of interest, and conflicts of interest are extremely important in the concept of the proper exercise of fiduciary duty. Single entities engaged in multiple activities, which is what commercial banks did to cause the Great Depression and to cause, again, all the problems that we saw in the United States in 2006, 2008. Now, let's shift to the United States. Capital raising in America was big prior to the revolution, afterward, continuing through the Civil War and expansion. Now, how does the United States regulate? Because as you know, we have a federal government and 50 states. Well, in the US Constitution, there's something called the Commerce Clause, which allows Congress to legislate commerce, business of any type, between two states or between one state and a foreign country. And it's this that gave rise to the ability to put in place state securities laws, the U.S. federal securities laws, the banking laws, but for the United States government to have federal preemption over state law. In other words, states can regulate if it stays inside their state, but they can't regulate if it flips to another state. And that's where Uniform Securities Acts for states came in, and the SEC, as the primary regulator of the U.S. federal securities laws, will make sure that the states stay inside their state, or anything that goes cross state is identical and regulated. So we had many types of regulation in the United States. You've heard of blue sky laws, there was merit regulation, but when the crash came, 1929, there were many, many, many hazards that were brought about by what commercial banks did. Excessive or imprudent loans, self-dealing, taking depositors' money and buying securities. Effectively, we put ourselves in a situation where commercial banks were just causing mayhem. And it was critical at that point to separate commercial banks, investment banks, insurance. Glass-Steagall Act came in, and what it did was it took each of the industries, siloed them, and moved everybody apart. It introduced a structure to regulation. It led to the Securities Act of 1933, the Securities Exchange Act of 1934, and the creation of the SEC. What did the U.S. Congress use to base the U.S. federal securities laws? Well, they had several choices. They could take merit regulation, they could take the New York State Martin Act, but what they did was they took the British Companies Act 1900 and years and years and years of prospectuses and full disclosure and enshrined that in the U.S. federal securities laws. So the concept we have in U.S. federal securities laws is full and fair disclosure. Tell the truth, prove you told the truth, prove you're doing everything that you said you would do exactly how you said you would do it. So it kept rolling along, and we have 6 main federal securities laws. Um, these work very, very well. In fact, the SEC is 90 years old. The US federal securities laws are 91 years old. Everything is working very fine. It's been amended many times, but there are problems. Insider trading, theft, various other things, the changing US landscape. And in many instances, a lot of changes were required. So the federal securities laws have been amended. But commercial banks decided that they had learned their lesson. So they were lobbying the US Congress to get rid of Glass-Steagall. They succeeded. And in 1998, when Graham Leach Bliley came in, Glass-Steagall was repealed. What it meant was commercial banks went back and started doing again what they did in the 1920s to cause the crash and the Great Depression. And guess what? It took us to the abuses that we saw from 1998 to 2006 and 2008, which caused yet another global crash. Here, the culprits were systemic risk, cardboard collateral, abuses again by commercial banks and lending. In fact, if you've read The Big Short, you'll get a very good idea and understanding about how all of these abuses took place. So we go through and we take a look at deregulation, which caused the abuses, a mix, a toxic mix of easy assets, easy credit, leverage, asset securitization, credit rating agencies being paid to issue AAA ratings over CDO structures that were full of toxic mortgages. In other words, everything that could go wrong did go wrong. And then we had the stage for 2005, 2008. Now, this is a period of time where billions upon billions were poured into institutions by central banks to keep them afloat. Did it work? No. For example, in the United States, the five great investment banks pretty much changed. Bear Stearns was sold, Lehman went insolvent, Merrill Lynch was sold to Bank of America. Surprise, surprise. Goldman Sachs and Morgan Stanley survived because behind the scenes, they were selected to turn their state chartered banks into national banks so that they could fall under US banking regulation and get the Fed funds wire. The real key in September 2008 was not the fall of Lehman, it was the reserve primary fund, a money market fund, breaking the buck. In other words, when Lehman went under on that Monday, the reserve primary fund had to mark to market 728 million of Lehman paper, which meant it had to market to zero. So its net asset value fell below one. And that evening, extraordinary measures were taken in the US Treasury and by the SEC to freeze redemptions on money market funds, which pretty much led to a situation that actually prevented rather, a repeat of the crash of 1929. Now, there were two choices then: reimpose Glass-Steagall or regulate hedge funds. And hedge funds, incidentally, had less than 1% of all worldwide investable assets. So governments chose to regulate hedge funds, thinking that they were the cause instead of regulating commercial banks, which truly were the cause of the problems 2005, 2008. So the language, the legislation we had, Dodd-Frank, literally ignored all the problems that were existing. The concept, so you can understand this, is the new legislation that came in was not designed to put out the fire. That commercial banks are told you can still do what you're doing. You need more credit and you need better risk management. And effectively, banks were taking TARP money. Banks were looking at the increased capital and saying, not economical for us to lend anymore. What we are going to do is stop. And that led to the emergence of shadow banking or private equity being the primary lenders. And they now lend more than banks. So now we're going into new developments. We have futures, commodities, options. All the markets are becoming linked. Now we get Bitcoin and cryptocurrencies. So we know the differences between money. When you deposit your money with the bank becomes a legal owner, you become an unsecured demand creditor. So Bitcoins are not money. Securities, money market funds, when you deposit them, you remain the owner. A custodian or a broker becomes the record owner. Cryptocurrencies are unregulated, money substitutes. They're virtual, they're derivatives with no intrinsic value. And the issue is, how do you regulate them? But the more important question is, what are they? Now, in the United States, we start to take a look at the concept of an investment contract, which is the Howey test. 30 acres of orange trees in Florida, an investment of money in a common enterprise with an expectation of profits to come from the efforts of others. And the SEC took the Howey test, looked primarily at the third element, an expectation of profits, wrote the Dow report in 2017, and it is using that as the basis to determine whether certain Bitcoins or cryptocurrencies are or are not securities. And if they find on an analysis under Howey that they meet the Howey elements, they say they are. So it's not just the sellers of the Bitcoin cryptos, it's the marketers. For example, about an hour ago, the SEC issued an enforcement action against eToro for creating a market in these instruments. And it said that eToro was selling them, marketing them, exchanging them, not registered as a broker. So it sued eToro, and eToro has agreed to stop all that activities. So now we go to the next level. We're going to Bitcoin. We're going to tokenization. We're ramping up and taking a look at blockchain, non-blockchain tokens, e-money tokens, utility tokens. We're taking this up to the next level. And as you know, that came out this morning, there's a final report and a draft bill on digital assets, crypto tokens and crypto assets as personal property. So what are we dealing with here overall? We know that most of what the United States has is really coming out of the concept of full and fair disclosure brought up by British law. And we know that the regulation of brokers and jobbers, which was developed here, which has gone over to the United States, is better there than here. Here we have a system that is quasi-regulation. We have an FCA rule book that is in desperate need of modernization and simplification, but we do have some good developments. But we need to point out that the concept of regulation is a yin yang. We have commercial banks on one hand providing credit, and we have investment banks on the other hand creating risk. And we need a balance of those. In 1929, the balance was destroyed. It took a long time to get it back. In 2006, 2008, the balance was destroyed again. Dodd-Frank did not restore the balance, so we still have that imbalance. So as we say, if you think about the W.B. Yeats poem, The Second Coming, where the falcon flies and can't hear the falconer, today we're in a situation where the falcon is flying and almost cannot hear the falconer. What do we need? Enhanced regulation, tougher regulation. So I think this is a good point to stop and see if anyone has any questions.
Well, thank you very much indeed, Mark, for that tour de force and a tour of history as well. We do have some questions already in, and please, if you have other questions or observations following Mark, please do put them in using the questions tab on the screen. But Nikki Holthausen has asked you whether you have any comment on insurers and the issuance in particular of insurance-linked securities and where they fit into this mix.
Well, it depends on which country we're talking about. Here in the United Kingdom, they would be regulated under the Financial Services Market Act and the FCA handbook. In the United States, insurance companies are regulated by states, not by the federal government. However, if they sell securities like what you're talking about, those would, in all likelihood, unless they fell into a very narrow exemption of an insurance product, and it's a tough exemption to stay in, it would then flip into federal regulation. They'd probably have to file a registration statement, a prospectus with the SEC on the basis that if they were securities, they would have to do a private placement or file and get a clearance.
Thank you for that. Shane Drinian, just comments that you mentioned cooperation between the UK, US in financial services regulation, but he asks, is the misalignment in settlement cycles, the sort of T+1 versus T+2, making that cooperation more challenging? Will the UK and the EU simply be forced to follow the US example and follow their market lead?
Well, let's take what the U.S. did going first before anybody else, as the U.S. going first and before anybody else. And I as a former regulator and somebody who was considered to be a commissioner of the SEC, my view is I certainly would have said no, we're not going to do it unless we do it on a coordinated basis around the world. I wasn't a commissioner, so I didn't get a vote. But I will say that. I think the initiative should have taken place in more coordination. I've served on the settlements task force, and I've done a lot of work working with the Treasury here and the government and the City of London Corp to try to come to grips with T+1, T+2. My view is I think we here in the United Kingdom need to move as fast as we can from T2 to T1. I think it's needed. I don't think T0 is good. I think T+1 is about right. But the issue is balancing ourselves with other jurisdictions, Europe and various other places. India made a good move. My view is there are problems. We are experiencing settlement problems, mismatched funding issues. So I think now we can't change what was done in the US by the SEC. It means that we need to make a move as fast as we can here in the United Kingdom. And in my view, we already know what the issues are. Bottom line is we need to take the steps to pick a date, bring it in. And my view is I'd be picking that date and bringing it in as fast as possible, as early as possible in 2025.
And then it becomes an issue of time zones and exactly when you have people doing the trades. Robert Pays asked for some comments around the crashes, the crash of 2008. His question is, to what extent should we blame the political pressure put on mortgage lenders to make loans to people for credit ratings to extend home ownership? It's already mentioned, he says, but seems to be important in the creation of subprime loans. Do you have thought?
Well, it's a good question by somebody who's a former senior SEC lawyer and wrote many of the rules and is one of my mentors. I think he's right. I think the issues were, if we go back and look at the U.S. government, everything's political. It was George Bush the younger that said everyone needs to own a home, everybody has to get a mortgage. And when you bring in the Federal Modernization Act and deregulate, you allow people that can't afford homes to have 5 or 10 homes bought on leverage and renting them out, and you create a financial disaster. I think that's one of the more astute comments that I've ever heard, and I think Bob is absolutely correct.
I mean, I think I'd add to that, kind of in the UK experience, there was obviously pensions mis-selling. And the idea of introducing personal pensions was very much driven by the government policy at the time. Yet the mis-selling wasn't the problem, wasn't the fault of government. The mis-selling was done by the banks and the financial institutions. So, where's the balance here between politicians wanting to take a particular direction and the proper exercise of fiduciary responsibility by financial institutions?
Well, what I love to point out, to the Congresses and the parliaments and the diets and everything is I say, you're an MP, you're a congressman, you're a representative. You're not a financial services regulator, right? You don't know the markets. Why don't you talk to the experts and ask us what we need to regulate? And if you look carefully at regulation, most of what we've had in the last 30 or 40 years has been crisis regulation. Huge problems, Enron and WorldCom. Oh my God, we need Dodd-Frank. Oh my God, big problems with anti-money laundering crime. We need the Patriot Act. Oh my God, we got a problem with BCCI and various other things. The Financial Services Act 1986 didn't work because regulators couldn't talk to each other. We had too many regulators. And on the other hand, we have regulators that are stuck because if you put yourself in a position of a regulator when there's pension mis-selling, the Lehman mini bond scandal, liquidity mismatch and various other things, the situation you get yourself in is you can't blame a regulator because a regulator can only do what the law that it is put in place by and is given tools to administer can do. So if, for example, the SEC's examination group, OC, would go in and look at firms 2005, 2006, 2007 and say, we're concerned, they would say, you have no jurisdiction here. It's us. We're entitled to do what we want. The tension really is understanding what is needed in a market. So today, for example, what is happening at the SEC is we don't have rulemaking and legislation going in to deal with issues in the markets. We have those things going in trying to change the market, changing the definition of a dealer to make it narrower to bring more people in, trying to regulate the safeguarding of assets, trying to regulate private fund disclosure, which is attempting to turn um, private funds, hedge funds, private equity funds into listed companies. So, in other words, what we need to do is we need to realize that we need to police the market to prevent the harms, the abuses, insider trading, theft, fraud, manipulation, deceit. We need to find a way to create positives, selling pensions. However, the big problem we have in this country is we have zero disclosure on fees that firms charge to sell, on fees that firms charge to manage money. We have a black hole, and we have a black hole in the legislation and in the regulation that really should impose disclosure, fee disclosure requirements and valuation requirements on the firms that sell pensions, that sell funds, that sell assets. In other words, you know, big round of applause for the SEC for getting tough on this stuff. 12B1 fees. Throw up your hands and go, oh my God, what are we doing here? Because, for example, I go to take a look at my pension and I want to know how much money I've had to pay in fees. Well, guess what? They're doing a double dip. They're taking money out of my pension pot to manage my pension, and then they put their funds in my pension and they take a fee for the growth in that without telling me the truth. So pension mis-selling, it really comes down to fees, it comes down to regulation.
Thank you for that. Nikki Holzhausen's come back to ask whether you think there's any benefit in making an attempt to manage global risk impact of financial risk in one forum.
You can't. We have financial risk, we have many types of risk, we have people risk, document risk, various other risks. The issue is we can't do it on a global basis because the laws and the policies and the concepts that each country have are different culturally. For example, what was good about Brexit? Well, European countries are civil law jurisdictions. We're a common law jurisdiction. And the directives and the regulations are designed for civil law countries, not common law countries. It was a mix that couldn't work. And when we talk about risk, the bottom line is you're never going to get countries, parliaments, congresses to truly give up to get the global risk. So, we have IOSCO, we have many forums where we can share things. Um, we need mutual recognition. We need substituted compliance. And there's some risks, yes, that we can deal with on a cross-border basis. But the problem is we have to come up with laws, rules, regulations, and regulatory systems that are designed to go truly cross-border. And if we impose protectionist legislation and rules and we keep things inside like what Europe has, the bottom line is we can't truly find a way not just to identify risk, and we're very good at identifying risk and measure risk. We're very good at that. But to put controls in place to deal with risk, the bottom line is we don't have passports like you do to travel to deal with risk flowing from one country to another. And until we can overcome that barrier, we can talk about unification and global risk management, but all we can do truly is talk about it.
Thank you. Robert Page just commented that he said some banks, of course, were threatened with litigation to make policy happen, which is always important to remember. I think we're coming to the end. I just wondered whether you could reflect on what you think the UK regulation has to learn from what happens in the US, and maybe vice versa. So, what are the big things system could take on from the other to provide some benefit?
Well, I'm in the process now of working on some proposals to go over to the other side of the pond to address and eliminate barriers that are in place that are historical. For example, firms here when they manage money could take orders from clients to buy securities. Can't do it because you've also got to be a broker. That's a mismatch. So 1992, when I was at the exchange and asked to comment and look at what is now Part 5 Criminal Justice Act, my objections were don't put in place price sensitive because that means it's going to be inconsistent with what the US has for insider dealing laws, rules, and regulations, or the law of insider dealing, which is driven by case law, not statute. So I said, take out price sensitive, take out the I would have done it anyway defense. In other words, there are many, 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 many opportunities as things are going through to put things in place that could be viewed cross-border. For example, the regular user test in Senate's 118 Financial Services Markets Act was just a creation. What it did was it caused more problems than helped. What would I do? I've got a proposal in to change Part 5. I'm trying to negotiate some bits with the SEC. The bottom line is, and we've got the Financial Regulatory Working Group, and we're working on things. Now, what's positive? We did passive market making. What's another positive? Well, the SEC put on a moratorium not to register non-US investment advisors because they felt the GDPR and other data protection laws in other countries would be used as a block. So if the SEC wanted to examine a firm, the firm would say, no, I won't give you the data because of data protection. So the SEC perceived GDPR and other laws as blocking statutes, put in a moratorium. September 2019, I started working to negotiate an end to that, and we were successful in getting that lifted for British companies in 2020. Guess what? Still in place in many countries around the world. So when you take a look at these things, it's critical. It's very important to be able to take what we perceive to be the blocks and negotiate ways around the blocks. So for example, I'm negotiating, I did Switzerland, Jersey, South Africa, Argentina, Denmark, Israel, I don't know how many different countries we've been working on things. It's a very slow process. And the dynamics of the negotiation, as many people know, and as Bob in particular knows, is you get people that are saying, well, this is my policy. This is what I needed to do to protect my investors.
Mm.
The query is, how do you define investor protection? It's not defined. It's in full and fair disclosure, right? And not ripping people off. But it's also a function of firms have or correct laws, correct regulations. It's also a function of how regulators examine firms. But if regulators put moratoriums in place, it means they're not going to examine firms. So what happens when something blows up and somebody says, a banking committee or somebody else says, why didn't you examine those firms? Well, we had a moratorium in place. We couldn't go in. I mean, the name of the game is if we really want good markets to protect investors and capital formation and orderly markets, right? We have to say we've got some barriers here because we are in a cross-border world. We are not in a country world where you have, I'm sorry, I can't make a telephone call to the United Kingdom. It's in violation of a law, or I can't visit. We're global. We have to make sure that we regulate banking, insurance, securities, commodities, futures, bitcoins, and all these things in a way that will facilitate cross-border, but more importantly, in a way that enhances investor protection without imposing barriers on firms.
Thank you very much. I'm going to squeeze one last question because Callum Graham's asked about digital operational resilience risk. Europe, UK, Middle East have central regulatory frameworks, while the US approach is very much more fragmentary across the states and industry bodies. Is there a federal ability to force faster, more centralized regulation in the US, or are we just going to have to live with this fragmentation?
I'd use the Commerce Clause and allow the Congress and federal regulators to impose that. And as they say, I wouldn't be shy.
Good enough. So there's a lobbying opportunity, Callum, to make some waves and see if we can get some change. So we are running out of time, I'm afraid. So it's just first of all to mention some of the upcoming events we have on Friday the 13th of September, Thames Vision 2050, looking at a safe, sustainable, and thriving port for London. On Tuesday the 17th, Innovation in Mental Health and the Galanos Project, which is about sort of developments in early release of mental health research. On Thursday 19th of September, The Lonely Brain: How Designing for Brain Health can help tackle the loneliness epidemic. So, as always, a really rich range of material in the Lord Mayor's Lecture Series coming up, and we look forward to seeing some of you there. Just remains for me to thank you, first of all, the audience, for your attendance and engagement today. Thank you so much for coming along, but in particular to thank Mark Berman for his fascinating run over the history of financial regulation, in particular to look at how the US and UK talk to each other or don't talk to each other across this field. Mark, thank you so much.
Pleasure. Thank you.